Hi, everyone, and welcome back to another episode of Prinsights Global. Today, we have a super special guest whose work has consistently helped to pull back the curtain on how money, credit, and policy shape all of our lives. I am so thrilled to welcome Chris Whalen. He's chairman of Whalen Global Advisors, an investment banker, he's an author, particularly of the just released book today of Inflated: Money, Debt, and the American Dream. I was just speaking to Chris a little bit before we started recording here. And I want to tell you what I told him, which is I am just in awe of the amount of work and research, the density of this book, Inflated: Money, Debt, and the American Dream. Chris, thank you so much for joining us here today at Prinsights, and welcome. And congratulations.
Thank you, Omi. My pleasure.
You cover so much history, as well as obviously insights about the present and the future. I wanted to dig into some of your chapters, and sort of go along from there. Your chapter, Free Banking and Private Money, where you talk about America's decentralized credit system, how it got to be what it was, and so forth, is so relevant today. We're seeing such a huge expansion of debt, and the private credit markets. Can you talk about the risks and the opportunities that you see from history through to this new version of free banking?
Well, that's right. We are kind of repeating the history of free banking with cryptocurrencies and things of that nature. But I remind people in the book that the dollar was the first cryptocurrency. When Abraham Lincoln introduced these green pieces of paper that bore interest, they were considered debt. In fact, all paper was considered debt. There was no paper money really, because it was all convertible into gold. So what I try and do with the book is explain to people how we got from being this sleepy agrarian society where barter was still 50% of all transactions right after the Civil War to being the dominant global provider of money and paper money at that, right? You saw the markets in the last 30, 45 days trading off. We're all going to leave the dollar. We're going to invest in China or whatever. And that turned out to be nonsense. The world is locked into a fiat currency called the dollar. That's it.
Yeah, and you talk about the evolution of that, and sort of how the power of what the dollar actually comes to mean. And it is fascinating, talking about Lincoln and greenbacks and a lot of that fiat currency that was crafted really to build America as well. But now we have a very different relationship with it.
Well, that's true, but it's funny how things come full circle. Gold is making a resurgence. I think you're going to see gold being held as a reserve asset by more and more central banks. Isn't that interesting? The Chinese recently sold 1 million ounces of gold. I'm not sure why. They have not traditionally been a seller, but I think the U.S. is still a leading country in the world because people trust us. It has nothing to do with our money. As a society, we love inflation. We're constantly finding new ways to put layers of leverage on top of the old world. What occurred to me today? Community development financial institutions. What is that? It's more leverage.
Right.
That's what it is. It provides currency that enables spending today. That's it.
It's, in your chapter entitled Robber Barons and the Gilded Age. I mean, this was something where there was this transition kind of into and around real assets. You talk about how gold is making this resurgence now as a real asset, and having real value, in contrast to the fiat system. And we're seeing that. We're seeing how wealth accumulation is different today, but in some ways very, very similar. And you did talk about that. Are we in a new Gilded Age? Are we approaching something like that?
I don't know if we ever got out of the first one, but the key story, I think, was Jay Gould and Jim Fisk and all their little buddies in New York in Tammany Hall, who realized that there was arbitrage between gold and silver and paper. This was a new thing. Most Americans had never even thought about buying a security debt as opposed to even equity, right? But these guys saw the possibilities and they immediately jumped on it. I proposed something funny the other day. I said, why doesn't the Treasury allow people to buy discount paper that was issued during COVID, which is a problem, obviously, for banks and for liquidity? The Treasury has been slowly trying to buy it back. but they don't have the money. We could
Sure.
let people pay their taxes. You go in the market, buy that bond for 70 cents on the dollar, but when you pay your taxes, you get par. Imagine that. We could
That
retire. Well, market movements always create opportunities and risks. The other side of every risk is an opportunity. And if you remember that, you can make a lot of money.
I really like that idea you just brought up. Can we imagine we have, about $37 trillion worth of debt or very close to that? A different way of monetizing that, a different way of actually using the debt rather than it just sort of being an overhang to the entire system.
And save the treasury the interest. Another funny thing, the Fed's been losing money. I'm sure you've been paying attention to this. Imagine if Jerome Powell gave the treasury all of the discount notes that they hold in their portfolio and said, here, retire it. The savings would be considerable. I don't know if Powell is smart enough to figure that out, but there's always possibilities, don't we?
No, I agree with you. I when you say I don't know if he's smart enough to to figure that out, I would agree that he isn't able to figure that out or to, make that actually happen were he to figure it out. But it is interesting to note that there is piles of debt on the balance sheet of the Fed. Clearly that the Treasury owes interest on and pays interest on, and that we could monetize and actually use for growth, actually change the entire equation. It's a fascinating point you bring up.
It would be a quick way to get quantitative tightening done.
Yeah, and have that debt actually be purposed, as opposed to not.
It's dead weight when it's locked inside the Fed, sequestered from the markets. Nobody hedges that either, by the way. You have trillions of dollars worth of debt that nobody trades. That's not helpful.
It is most certainly not. You actually delve into the history of the Federal Reserve in your chapter, "The Rise of the Central Bank," which I was very I read it multiple times. But you explore the creation and given where we are at right now with we just talked about Powell a bit, but with the credibility of the Fed so strained and markets so sensitive to everything it says and does and might say and might do. How do you frame the role of today's Fed versus how it was originally intended to be and how that's changed over the years, if it has?
You remember the stories about Jekyll Island when the bankers all went off to, talk about creating a central bank that they would control. The trouble is that once we got into the Depression and the New Deal, FDR turned it into a Washington agency, and the Fed became an engine for progressive engineering, from the gold seizures to essentially a central planning function that developed within the Board of Governors. I talk a lot about a good friend of mine, Walker Todd, who I worked with at the Federal Reserve Bank of New York.
Sure.
Walker was a Renaissance man, the collateral officer, the discount window, but he was also a conservative, and he was forced out of New York, ended up working for Jerry Jordan and Lee Hoskins in Cleveland because conservatives weren't tolerated in the central bank. They weren't tolerated at the Board of Governors in Washington. So to me, that's the problem with the Fed today. They're really a central planning agency, much like Gosplan inside the Soviet Union, and they get it wrong constantly. And that's really the point of the ninth chapter of the book is when we talk about Janet Yellen and Bernanke and Powell, what they did with no consent from Congress. They didn't tell Congress we're going to nationalize the money markets, do this and that. We're going to expand our portfolio up to $7-8 trillion. And that's had a lot of detrimental effects on the economy. We're still living with it. When you look at home prices, the fact that young families can't buy a house, that's because of Jerome Powell and Janet Yellen and the decisions they made. If they had just stopped, Naomi, say 2-3 years into quantitative easing and not reinvested in the portfolio, just let it run off, because the bond market was functioning by then. You remember, it had much less of a problem. Home prices would have come back down. But instead, here we are.
It's really it is really shaky for the economy, for the housing market, as you mentioned, because you're right. I mean, the financial crisis, you were in it. I mean, we were all watching as it was unfolding, and the reality is, yes, there could have been a roll off instead of a double down on the assets that the Fed held. And then when COVID happened, of course, the book that had, at that point been whittled down from a very high level of 4.5 trillion down to sort of 3.7 up to 4.1, but going into
Right.
COVID on that level, all of a sudden was at 9.
Right. That's right. And because of the size of the federal deficit and the debt, the Fed has to grow its balance sheet. This is illustrated by the fact that the banking system in the U.S. basically doubled between 2008 and today. Is that an indication of low inflation? No. It means that banks have to be buyers of government debt. And it also reflects the fact that the Fed had to ride to the rescue in March 2020 because the market stopped. The Treasury couldn't have raised money if they wanted to. So the Fed had to go in and buy it. That indicates that we need to make some changes.
Now, if we did have another crisis, and can you, there's so many ways that that could potentially unfold. Do you think, given where we're at, the Fed comes back in and re-ups its book?
Yes, I do. In fact, I will tell you that they have to cut rates this year. There's so much destruction going on in commercial real estate and other sectors, not consumers. This is a consumer problem or commercial problem this time. And I think they'll have to relent. But the problem is when they do that, you'll have another little mini boom in housing. You'll have a little mini boom in the markets. And then I think we have a significant correction in home prices around 27, 28. And we go back down to 2020 levels, which means 20% drop from where we are today. And yet, home prices in New York haven't moved. We still saw one of my neighbors sell her house in 2 weeks across the street from me, went $100,000 over the ask. And I thought, and New York's an awful market for residential housing. The politics here, it really makes it one of the worst markets in the country when you're buying loans from different areas. California is a lot better than New York, believe it or not. And yet, home prices are still going here. And I think that's a function of inflation.
Do you see that at just one part of the market in terms of which component of the housing market is seeing those sorts of levels?
Yeah.
Is others?
Below the maximum limit for Fannie Mae and Freddie Mac, so filling in about a million one, I don't like going above that level in New York because the market disappears. And so higher price homes outside the city are softening. In the city, not so much. There's a lot of young people who want to live here. But I think overall, you're seeing spec homes in the South, in the Southwest. They're all flipping the rentals. You know what I mean, Naomi? That's not a good sign.
Yeah, and it is different from well, when I first came to New York and got involved in banking, and I'm sure you're still in New York, but sort of back in the day where things were expensive but sort of manageable without a ton of leverage, and that's really just not the scenario today.
But you have new build residential properties here that are going to special servicing because they have too much debt and they're fully let. I mean, it's not like they're half empty. So that tells you how much volatility the Fed injected into the markets. So I have a 3% mortgage on my house, by the way. That's not normal. Today we're right in sevens. But that ebb and flow also had grave consequences for commercial real estate. Commercial real estate had gone up for 70 years. So when it starts going down, that creates problems. And people say to me, Powell's got a 2% inflation target. Well, we have to have 2% inflation in commercial real estate or it doesn't work.
Right? No, exactly. And you cover like in more depth in your chapter, debt and inflation, that connection between just rising debt levels in general and long-term inflationary trends and what inflation actually even really means. And now that we've got U.S. debt at again, close to 37 trillion, it's almost 130% of GDP as a ratio. Inflation, whether Powell wants it at 2%, whether it's 2.8, 2.2, if it goes up to 3, it's still there, but just as a component complementary to anemic growth. Are we stuck in just like an inflationary cycle that no policy maker, no Fed officials really able to control or do anything about?
Oh, I think very definitely, Nomi. And the reason is this: the Fed was tasked in the 70s, you remember Humphrey Hawkins, with creating employment opportunities. The Democrats wanted to guarantee everybody a job, Hawkins and Hubert Humphrey, but they compromised and said, no, the Fed will run interest rate policy so that there's always full employment, whatever that is, right?
Right.
Well, what happens when the horse just kind of runs away and the Fed doesn't really have the ability to impose deflation on the system the way, say, Paul Volcker did? This time around, the Fed didn't even begin to get home prices to fall. They couldn't. They were so afraid of the deflationary impact on debt and on markets. And remember, their first priority is not full employment or low inflation, it's keeping the treasury market open. So when they saw that that was a problem, they basically had to relent. The rate tightening that we've seen so far, yeah, 7% mortgages is horrible, but is it really that high in historical terms? No.
Sure.
But I think we've lost the ability to control inflation, the bottom line.
Yeah,
If you're in the federal deficit, that's a little different. If you stop creating leverage, like various types of vehicles that we always manage to create. When we can't make money one way, we do it another. That's another possibility. But then I think you end up in another debt deflation. Irving Fisher.
Yeah, and you kind of do talk about if that happens, or if we do see another form of financial crisis. I mean, if the banks and the commercial real estate market does have some sort of an implosion, which, given sort of where delinquencies and defaults are going, is not out of the realm of possibility. And you talk about how prior crises have sort of developed more healed. If we had a crisis, and this is a bit of kind of what we just discussed, I mean, is there a way that the Fed could obviously not see it coming because they don't appear to be noticing, but contain it? Or are we just back to the same hamster wheel of, all right, QE, rates down to zero, and we just do it all again?
I think those are the only tools they have right now. The Fed is not a flexible institution in terms of coming up with new ideas. They are also they tend to discard models which don't work anymore. Like remember the Taylor rule and all of that. So what would they do? I think they would do exactly what they did in 2020. Down the road, what happens? There's a very interesting paper that I highlighted in the book by Josh Menand and his colleague Younger, who works at the Fed in New York. And they talk about the legal basis of the Treasury market and how, in fact, that green piece of paper in your wallet and the Treasury bills are the same thing.
Mhm.
What do you think a future government's going to do? They will just monetize all the debt. They'll turn it into currency and you'll hyperinflate. That's Argentina, by the way. And I think in a lot of ways, we should take some lessons from President Millet and what he's had to do to get that country back on track. But, the political will's not there. If you watch what's going on with the budget right now and President Trump, it's a joke. These members of Congress ought to be sent home. And I worry about that because it means our democracy is dysfunctional and we're eventually going to have to just hire a manager who's going to tell everybody what to do. That's not part of the American dream, I don't think.
No, and you're right. I mean, if you're have such an immense budget, you have such an enormous amount of debt, you have, before anything happens in Washington, before lights are turned on, you're paying like $1 trillion in interest payments, given where levels are, and that's not increasing the debt. That's just kind of where we're at. Yeah, how can you even consider where growth should come or where investment should go on a really strategic basis, on a competitive basis internationally?
Well, look, this is not by any means an impossible situation to fix. It just takes will. So what should we do? We should freeze spending for a couple of years, and I would have a very aggressive program to allow investors to buy back every discount piece of Treasury debt out there and use it to pay taxes, tariffs, whatever other owings they have with the U.S. government, right? We have enough assets in this country to fix this, don't we? But we have to have people in leadership positions that actually know what they're doing. Compare Janet Yellen and Carter Glass, okay? and some of the other figures I talk about in the book. The people of the 1930s who led this country through two world wars and the Depression were giants. These are people who worked in finance and business. Today we have celebrities who can barely tie their shoes. And they freely admit it too. If you talk to most of them offline, Washington is just a celebrity popularity contest, and they are worried about next year because if they don't bring home the bacon, they're going to lose their elections. So the 2-year election cycle that our founders thought was such a good idea turns out to be a really bad idea. you know, that's why other appointed officials have longer terms. Fed governors have longer terms. And if Donald Trump doesn't stop yapping at Jerome Powell, Powell's going to get through his term as chairman next year, and then he's going to stay through 2028, just like Mayor Eccles did when he was involved in that dispute with Harry Truman. They sat there and they thought, well, and then remember they appointed William McChesney Martin, who they thought they could control, and he turned out to be the greatest defender of the Fed.
You're
So
good.
presidents always think they can control Fed chairman, but they really can't.
That's a great lesson. You really do hone in on that in your book, Inflated Money Debt and the American Dream. You mentioned Carter Glass. Of course, one of the architects of so much legislation back then, back during that period into and around the Great Depression, and also in terms of beating back some of what the bank excess had been back there with the Glass-Steagall Act and so forth. A lot of things that required a vision.
That's right. And yet today the gold is still valued by the United States at the same rate that FDR set when he told Jesse Jones to go out and buy it. They funded that with debt, by the way. And Carter Glass was one of the few Democrats who would stand up to FDR. And he said, "This is ridiculous. Why are you doing this?" But they didn't care. The progressives don't worry about details. They like to act.
So where we're at today, we talked a little bit around the edges of gold, its role, what it is as a hard asset. And of course, right now, we're seeing central banks pile up on gold. We are seeing it as a diversification to the dollar, but as you mentioned, the dollar is still prevalent. I mean, of course, it is still the reserve currency, aka Bretton Woods, and all of that. How do you see gold playing into where we're at right now, and also from the standpoint of even an investor, where do you see it?
I think gold is making a resurgence on long gold. I have been telling my readers to consider it as part of their portfolios. I don't think cryptocurrencies play the same role. I'm very dismissive of crypto, but I do think that global central banks are going to hold a lot more gold as reserves in the future. They're going to hold currencies of their neighbors and their trading partners. But we are going to go back to a multilateral world over, say, the next 50 years. The dollar will still be big. It'll be the biggest currency because other countries don't want to import the inflation that are required to have a big currency, right? But having said all of that, I think gold is going to make a resurgence. On July 1st, it's going to be considered a liquid asset for the purpose of Basel if it's in the vault. And there's a shortage. So my sense is that the fact that people are taking delivery of gold and silver today in ways that they weren't indicates to me that the price is going to continue to go up. I think it'll become a more visible measure of inflation for investors. I mean, that's a good thing. I would love to see Treasury issue coins based on weight. Our friend Judy Shelton, she wants to have gold-based bonds. I endorse her idea, but I think more we have to teach Americans about gold again. We have to teach them what money is. And money is metal. Everything else is debt.
I absolutely agree. I spent a lot of time in gold mints and mines actually, and it is interesting how all the confluence of what you discussed from where we've been historically to where we're at current day with respect to the Fed, to debt, to inflation, to all of it, lends itself to opening up for this hard asset gold for individuals and investors that prior to this period might not have been as engaged or as apt to invest in.
The whole premise of Bretton Woods was anti-gold. FDR tried to kill it, but he didn't quite do it because they were afraid. Remember, even after he had confiscated all the gold, they still had that ratio between dollar issuance and gold. He couldn't print more paper unless he took our gold away from us. So that's now coming, I think, fully around, and we're going to start having people more and more talk about gold as a reference point for other asset classes. I think that's good. We may not have enough of it. We may have to go look on other planets because I'm not sure how much more we can get above ground. But it's certainly going to, I think, figure more prominently in the future.
Yeah, no, I absolutely agree with you. This, by the way, our conversation's gone by so quickly. I could talk to you for a lot longer, and I know you've got a really busy schedule with your just released book, Inflated Money, Debt, and the American Dream. And I encourage everybody watching here or listening here today to go out and get a copy. I have read it several times, cover to cover, and that was being so impressed, by the way, Chris, with just how dense it is and how well researched and just how vast it is at explaining how we got to where we are today and from where we've come. So I want to thank you for that and ask if there's other any other points that you want to make to our listeners here today, where they can find you, your other work, as well as obviously we'll put up the JPEG and the link to purchase Inflated Money, Debt, and the American Dream.
Well, first, Nomi, thank you for your time. I look forward to having another conversation with you. We'll have plenty of reasons to talk. I publish the Institutional Risk Analyst. I am active on X and LinkedIn under RC Whalen. And I also publish a column for National Mortgage News. I spend a lot of time with some of the biggest lenders in the country. So I look forward to hearing from you all.
Well, again, thank you so much. You are really such a funnel of incredibly necessary information and insight and perspective, Chris. And I congratulate you again on this new book. And I appreciate you. I'm really glad we had this time. And everybody here watching today at Prinsights Global, thank you so much for tuning in.